So expectations that 6 months out, 12 months out, we're not going to be investing in capital expenditures. That tells you we're going to need fewer employees than what we're envisioning right now today. And that means that we're going to be able to continue paying less and less to the applicant pool as it grows.
Welcome to the Rose Show podcast. Welcome to the Rose Show. Today I'm here with Danielle DiMartino Booth. She is CEO and Chief Strategist at QI Research, and she brings fantastic economic, financial research to everyone who sees her on Twitter, as well as her amazing website. Thank you so much for being here. I know you're so busy. How are you doing over there today, Danielle?
It's pretty warm and toasty where I am in Dallas, Texas. But no, I'm doing great. And it's great to see you again. Thank you for having me on.
Absolutely. Thank you so much for coming back. How was Maine, by the way? I know you were there recently. So beautiful up there this time of year.
It really is. I mean, for somebody who is in sweltering 109-degree high temperatures, it was great to be back with all my friends in Maine and do a little bit of fishing, a lot of talking about the economy with some friends that I've had now for 12 years. So it was a very welcome reprieve. And as always is the case with Camp Kotok, I learned so much.
Wonderful. Well, thank you so much for being here. And I want to get started with our current economic state that we're in. Let's go under the hood and let's look at the data, your amazing research, all your extensive work that you do at QI Research. And let's talk about some leading indicators. And because there's lots of data lags. So I think we start with the pink elephant in the room, debt, massive debt, government spending to no end. The consumer is accumulating much credit as well. Debt to GDP ratio per Fred Q1 2023 is about almost 119%. It is crazy what's going on. Interest expense is higher. I think we're at 32 trillion in debt and about 1 trillion in expense. So Danielle, please tell us your thoughts. This isn't sustainable. When will they realize that? And also please talk about the Fitch downgrade as well.
So I think to answer the first part of the question, I think the Fitch downgrade is because there is an acute deniability about the ability to continue to just grow the national debt as if it didn't matter. But if, as I suspect will be the case, and we're coming into a chapter of more rational, more normal interest rate policy than we've had for 40 years, then I think that Uncle Sam is about to learn the hard way that racking up debt in a zero interest rate environment is a lot different than actually having to service it with interest rates that are even in the same zip code as normal or normalized. And it's going to, I think it's going to force, certainly not by choice, not politicians, but it's going to force our politicians to start to make some difficult choices simply because servicing the debt's going to cost so much money that they're not going to be able to continue to spend like drunken sailors on whatever the initiative might be.
Well said there. Danielle, do you think it's going to be too late when they stop? Is there any solution to this massive spending that's going on?
So I think that there are thoughtful and true avenues that we can take to reforming spending. I hope that is the direction taken. But again, the reason that Standard & Poor's downgraded the debt of the United States back in 2011 was because there was this great big debt ceiling standoff and nothing came out of it in terms of entitlement reform. Well, guess what? All these years later, we see a second downgrade from Fitch, which makes the downgrade formal, by the way. You have to have 2 out of the 3 major credit rating agencies to make that downgrade stick. But all these years later, Fitch recognized the same thing, but yet with elected politicians that are even more divided than they were. But there are ways, that we could reform our entitlement spending that should be pursued, that I hope becomes the silver lining that comes out of politicians finally being restrained, that they have to look for ways on the other side of the balance sheet to start to reduce the government's carrying costs as a result of the Fed really running rational, normal policy for once in the past 40 years.
Thank you for that. Do you think that 2% inflation is even possible with all this mass spending that's going on?
Well, I do think that inflation works both ways, and that the downward momentum for inflation, the rising price of gasoline notwithstanding, again, we are in what I would consider to be a global recession. So I think that there will be a lid on the demand for energy. But nonetheless, even though we may have some bumpiness and base effects going forward for the next few months with our top line readings on the consumer price index, I think that the greater weight is going to be that of shelter inflation, which is coming down pretty hard and is, of course, the largest input, about 40% into the CPI. And we are seeing that with a very aggressive level of spec home building on the single family side, to say nothing of apartment construction, and a lot of Airbnb hosts who are finding out that they simply can't make their ends meet because that weekly cash flow on which their mortgage was predicated is no longer coming in every week. So I think that we are going to see continued downside in inflation led by the shelter component.
Yes, there's definitely an oversupply that could easily flood the market. There are a lot of vacancies. And, I always say that it doesn't matter how you're locked in at any rate. If you lose your job, if you can't make that payment, you can't. And so you have a lot of issues going on in the housing market, which we'll talk about in a little bit. But I want to go into something that not enough people are talking about, and that is the ERC. It's not just a credit, it converts to cash. If your credit is actually higher, right, than their payroll expense, you get that as a check, right? And there's billions monthly that's contributing to that debt based on this ERC. And I know you've made that statement quite a few times as well. I am getting emailed daily. I'm getting phone calls to my business, me as well as other executive officers. They're like, oh, you could qualify. And then they'll even write and say, you're not getting back to me. This is free money for you. Why aren't you? This is money that you can qualify for. And it's just so disconcerting. And they get paid a commission, these companies, 20 to 30% to give out this money. And so you have that going on. And I think I saw in Bloomberg, March 2022, they were suspicious returns that I think was over $2 trillion. So there's a lot of, it's fraught with fraud. And then, they have enforcement, they have auditing expenses on top of that. Tell us, Danielle, what is your research telling us about this ERC? And is there going to be backlash in the future regarding this?
Well, the good news is that the backlash has already arrived. In late July, the commissioner of the IRS came out with a statement saying, we are aware that the vast majority of claims that are being filed at this juncture have nothing to do with companies whose business was interrupted because of the pandemic. Mm-hmm. We're on to you. We understand. And the word that he used over and over again was scams. And so if you look at the data, really when getrefunds.com and innovationtaxes.com, by the way, two companies, same holding company, but when they became very aggressive in their marketing tactics, I would say probably a year to 18 months ago, you saw monthly payouts kick up from kind of the teens, pushing into $20 billion a month. The month of December 2022 was $26 billion a month. June was around 28 billion. July of 2023, just last month, was $30 billion paid out. And that's a lot of money that is being sent to people, as you rightly say, in cash. But the good news that I would offer is that the IRS commissioner has gone so far as to say, we have gone through the majority of the backlog of these claims, and we are on to the fraud that is being committed. And we've gone so far as to approach Congress and ask for Congress to pull the plug on this early, because we know the types of actors that are playing in this space, preying upon business owners who are being told that they're leaving money on the table, but it's certainly not being explained to them. And then there's just the people who are committing outright fraud, who have created companies, which is what happened with the expansion of the employee retention credit when Biden expanded eligibility to include post-pandemic startup companies. We know of plenty of companies that are startups with fictitious employees who have made this claim for $26,000 per employee and are flat out ripping off Uncle Sam, ripping off you and me, the taxpayer. So I am gratified to be able to report to you today that the run rate for August 2023 is probably somewhere in the neighborhood of 16, 17 billion. Again, that compares to July with the $30 billion paid out. So it looks like I'm finally applauding the IRS, because if we look under the hood here, looks like the fraud is starting to come under control, and that's good news for U.S. taxpayers.
Thank you for that great news. I have to say, Danielle, you're on the forefront of data and research. This is amazing. So we got this. This is great news for this month. And I hope I stop getting those harassing calls and all those emails as well. It's unbelievable. Yeah. And the PPP was by the SBA. Now, I don't know if people are aware, the ERC is administered directly by the Treasury. So, right. And so all they need to fill out, these people, is a 941X, I believe. My husband's a tax attorney. So he was like, tell me about this. Like, it's so simple. And it's unfortunate. It's just so much fraud. So this is great news, Danielle, that it's coming down. And that's the most important thing. So that's good. So let's go over to these higher rates. Okay. It takes time to work through the system. Smaller businesses are effective as they're more sensitive to these change in rates. Now, corporations, I know they have longer for refi. Commercial real estate is already in refinancing mode. So, and now we're seeing the long-term yields heading up, the 10-year, the 30-year mortgage rates at their highest levels in a long time. Danielle, please tell us, what's going on in this market? It's a slow process, but what do you foresee with this corporate credit crunch?
Well, first of all, when the Bank of Japan came in and changed its yield curve control policy, that really was kind of this last accelerant, if you will, put on the fire. It started with this kind of soft landing narrative, and the wealth effect was going to be sufficient to save us. And of course, you've got the employee retention credit running in the background. I don't bring that up willy-nilly because it was a huge source of very real income that prevented the U.S. economy from going into recession. But you do have the 30-year fixed mortgage rate north of 7%. We are indeed seeing in real time commercial real estate not be able to refinance. And the next shoe to drop, I would say, will be corporate debt going into 2024 and 2025. When you will see companies that are being forced to refinance. But as you started this discussion off, small businesses, trying to get operating costs financed, it really is difficult. And they're the ones who have been kind of raising the white flag and saying, we can't do this. And that's a tragedy. You don't want to see that. But right now, what we're seeing play out, not just in rising bond yields, but in persistently high borrowing costs, is something that most players, whether you're a corporate player or a sovereign player or a household, just simply are not used to. A higher for longer, more resolute, more disciplined approach to monetary policy with Jay Powell at the forefront.
Well said. I think we should go right into housing because we're talking about these higher rates, and we just got the report today from the National Association of Realtors, and we see the pattern persists that home sales are down and home prices are still up 1.9% year over year. Now, like we discussed before we started recording, there's going to be an influx of supply of all these vacant properties, and we have Airbnb. So even if the Fed has locked people in their homes with low rates and caused low inventory, what happens if they lose their job or they just can't afford? Inflation is cumulative and they can't make their payments. And then these income producing properties and like multifamily, which has a huge supply, what if they don't produce income and all this floods to the market? I know real estate is historically a very slow process, but this seems there's a lot of factors going on here that could really speed up this process. What is your research showing regarding the housing market?
So I think that there are a confluence of factors, many of which you've identified already, and that is that a lot of investors in the space are hoping for relief in the form of zero interest rates yesterday. Come to the rescue of the fact that they've got an investment property that happens to be vacant, and against the backdrop of slowing discretionary spending, which nobody denies. You've started to hear from airlines and hotel chains that travel really is taking it on the chin, and that it's not just a seasonal reflection, but that on a year-over-year basis that you're seeing travel slowing. And that's going to have a real impact on people who bought investment properties and thought that they could live the Airbnb dream. Mm-hmm. And in addition to that, as you rightly note, as we start to see the shadow inventory come out of the shadows, you'll have a lot of baby boomers who start to contemplate, gee, I've got all this equity that's built up in my home. Should I downsize at this point? Should I look to possibly renting? There's all of this supply coming on the market. And there are a lot of people who are also contemplating buying a home, maybe for the first time, saying, boy, if I'm going to wait this storm out, there are a lot of apartments that I can choose from in the next few months to rent instead, and wait for mortgage rates to come down to where then I can afford to buy a home. So it's a huge number of factors. At the same time, you've got single family home building, a lot of spec building going on, and a lot of home builders who are starting to get a little panicky because they've done what they can to incentivize new home sales. And at this point, they're starting to cut into their margins. A lot of them are holding finished properties off market so that they can push off this day of reckoning. But I've just 2 out of the 3 cohorts, the baby boomers being the exception, 2 out of the 3 cohorts, whether you're talking about home builders or investors in single family housing, they really are hoping for zero interest rate policy to come about very quickly in order to save their business models.
Yes, they keep hoping. That's that recency bias, but I think we know better, and it seems very unlikely that we'll return to that, especially with the way Powell's been. And you've been so right on, Danielle, since last year, higher for longer stance, and he has not wavered. And we're going to get into that as well. But I want to touch into the labor market. You had a great tweet that you put out recently, and it was about the mismatch between employer and employee. But then you went on to say how the pay is coming down. And I agree with that. And I'm noticing on the forefront in manufacturing, as a business owner myself, since last summer, the end of last summer, I saw a change going on. A lot of new applicants coming in, unlike before then. And then into the fall, there were a lot of people applying. There was definitely a mismatch. They wanted more money, and they also exaggerated their skill set. Somehow they believed they had all these skills, and they wanted to work remotely as well. So they wanted a lot of benefits. But then I think reality set in, and this year we definitely are paying much less than we were. And there's still a lot of people who are applying. With our type of business, manufacturing, we're always having a steady flow. We have a lot of turnover, unfortunately. So we always have a steady flow, and we're always having our ad up on Indeed. And that's a great one. I always use Indeed. And so I'm noticing that just that change occurring, and we're definitely paying much less. So let's talk about your research and what you're seeing with the labor market. Now, they're saying it's healthy, how it's going. But do you think it's going to go even further, and we could have that unemployment number spike up significantly?
I certainly think that that's a possibility. And the fact that the labor force participation rate has increased in recent months has actually kept that unemployment rate depressed. But I'm going to cite for you, you're a manufacturer, you'll actually appreciate what I have to say. I'm going to cite the oldest data set in all of manufacturing, which is the Philadelphia Fed survey that comes out every month. It dates back to 1968. It's a treasure trove of historic data. And what we're seeing right now is really a collapse in future capital expenditures.
Mm-hmm.
Now, Philadelphia is kind of the heart of the chemicals industry. Chemicals are at the very beginning of the pipeline, the very beginning of the cyclical economy that feeds down into stainless steel manufacturing at some point, but you got to start with a chemical first. And so expectations that 6 months out, 12 months out, we're not going to be investing in capital expenditures. That tells you we're going to need fewer employees than what we're envisioning right now today. And that means that we're going to be able to continue paying less and less to the applicant pool as it grows. And I would caution a lot of your viewers and your listeners to be careful with the Department of Labor weekly initial jobless claims data. How on earth do you have a company based in Overland, Kansas with 30,000 employees, Yellow Trucking, go belly up and have initial claims decline in the state of Kansas? I really don't understand that. However, I would just say that if your viewers want to have a better feel for where the job market is on a day-to-day basis, then unbookmark Department of Labor, unbookmark Bureau of Labor Statistics, and add dailyjobcuts.com to what you're looking at on your dashboard on a daily basis. Dailyjobcuts.com will tell you that a seat supplier to Chrysler, Jeep, that has gone belly up, 453 people in a plant that no longer have their positions as of January. Find real-time indicators to track. Trackindeed.com on a weekly basis. It's free. You can look at that through the Fred database and see how far off the peaks that data has come as the demand for jobs has decreased. It has not vanished and gone away. But notice that Silicon Valley did major layoffs, but at the same time, they're not on some big hiring spree right now. They're not replacing those positions that were destroyed. And that is reflective of the slowly grinding down level of economic output and the fact that a lot of employers don't see the demand looking forward for expanding their headcount.
Excellent. Well said. You have to look at these leading indicators, or at least current indicators, that data site that is about the past. These employment numbers are the past. We need to look at the ads on Indeed or Zip Recruiter, and less companies are seeking workers. It's a fact. Even Zip Recruiter came out and said that they ended up cutting their labor force by 20% because there was so much softness in the job seeking market. And, and I know that our company is a manufacturing company and we speak to other manufacturing. So we're actually like the base manufacturer and we supply other manufacturers. So I'm speaking with other product makers, quite often. I'd say over 1,000 a month, probably. I have a significant customer base and they're all streamlining. They all complain about declining productivity. They complain about their workers. And they talk about they want automation, and we do provide automation with our equipment. We utilize some type of automation to streamline their processes, and that's how they come to me and they say, we have declining productivity, and they just say that their worker has changed, and it's dramatically changed since COVID, and their productivity has just gotten worse. So they're telling me they're streamlining, they're cutting back, their costs are very important to minimize, and margins are compressed. And this higher cost of debt and capital is just starting to work through the system. Like you said earlier, corporations, they have until 24, 25. So it's going to take time. These higher rates don't hit everyone the same way and at the same time, right? It takes time. It trickles up and it's working its way up. And that's very, very concerning. So
if I could put a postscript on what you just said, I think one of the biggest disservices to a lot of the younger workers is the fact that the mainstream media really has been cheerleading this kind of employer empowerment narrative. Yes. And it really is working against an entire generation of individuals who are being told, just tell them, take this job and shove it. If they don't give you everything you want, then don't sign on the bottom line. But this is a really bad message to send when employers simply don't have it in them to squeeze their own margins to kingdom come. I understand that there are some very high profile unions who have gotten major pay raises, but for this to be painted with a broad brush as the next era of I'm going to give up my profits in order to pay you more is absolutely ridiculous, because under such scenarios, the company simply cease to exist. They're not going to stay in business if they can't make some modicum of a profit margin.
Agree. Perfectly said. These companies, and it's a reality check. And that's the point of this podcast and speaking with you, that, you bring so much amazing research and the truth. And that's the key. You're an independent, just like I am. And we speak the truth and what we either study, research, or experience daily. So thank you so much for that, Danielle. Manufacturing, it tends to be a leading indicator, and it's in severe contraction. And it has been for a long time. It's in a recession. And I experience it. I can hear it from my people, and just a reality check. People need to be not so entitled. They want everything. They want the whole pie, and they want to eat it too. It's just unbelievable what's going on.
I mean, if I could just add one more time, I
Please
hate
do.
to interrupt, but we hear constantly about this industrial renaissance. But if you peel back the onion a layer and you look at industrial production net of auto manufacturing, which was simply playing a job of catch up, waiting for those semiconductors to come in. If you look at industrial production net of autos, it's been in contraction for some time. I understand that Ford Motor Corporation took whatever it is, $9.8 billion, and they're going to pop up an electric vehicle plant or two. Will it make money? Probably not. But that doesn't speak to the broader industrial recession that the country is in, that so few people even begin to recognize, because we're being told that somehow, some way, we're in an industrial miracle.
That's so important. I know you have great research with the auto industry. Excellent points there, Danielle. Thank you so much. Well, some people are saying inflation is re-accelerating, not back to like 6, 7%, but they're saying, probably 4 or 5s. Then other people are saying that we're going to be in deflationary territory and that everything's deflating, we're coming down. What are your thoughts, and what are you seeing with your research?
So I think that there will be forms of sticky inflation. I don't think, however, that the biggest of them, which is shelter, which is 40% of your CPI, I don't think shelter is going to be one of them. Shelter is not going to be sticky. It's going to be slippery on the way down. So be careful and watch out. And when you're looking at individual sectors, yes, there is a big chance that healthcare inflation becomes sticky and ingrained going forward. But for that very reason, we're seeing healthcare insolvencies second only to consumer discretionary insolvencies, simply because hospital chains, what have you, they cannot make a profit. And pharmaceutical firms, and especially senior living facilities, we're seeing one bankruptcy after another in these industries. And that tells you that healthcare inflation itself is problematic, not just for those who are having to pay for it, but for those who are having to pay individuals who work in that industry. So I think that I'm not too terribly concerned about outright deflation, because there are going to be areas that are stickier, but I'm very, very concerned about getting to the Fed's 2% target quicker than most people think, after we get past this spate of increased gasoline prices that, by the way, is not good for your average working US household to be paying more at the gas pump. That comes right off of your take-home income. But I think that the underlying direction of the CPI is downward going into the end of 2023. And I would try and be as highly cognizant of that as you can, because the backdrop is that your baseline costs to feed a family are still much higher than they were prior to the pandemic. So you could have a situation where incomes are declining because jobs are being lost, but your day-to-day costs of living are persistently higher than what they were in 2018 and 2019.
Yes, well said. Inflation is cumulative, and just because inflation is decelerating and coming down does not mean these prices are coming down quickly as well. Very important point there. And there's definitely a lot of bankruptcies. I saw that there was bankruptcy. The first half of this year was more than all of last year, and we have consolidation going on. Excellent point. Thank you for bringing up the healthcare. Those are all things to watch. And I know gas is going up in price, and we'll have to keep an eye on that one as well. So a lot of expenses, a lot of high prices still persistent. I'd like to go into the Fed. You made some excellent calls. You seem to know exactly what they're doing. So they seem to be divided at this point, and there seems to be some dissent going on behind those Fed doors. Powell appears to be the most aggressive in the bunch, and he seems to want to continue. What are your thoughts going forward with this dissent? And do you believe they will continue with higher for longer? And I'm sure they're nearing the end of this rate hike cycle. What are your thoughts with the next 6 months?
So, if we do see a quick acceleration in headline CPI if we have this inflation scare going into the fall, you could see the probability of a Fed rate hike before 2023 comes and goes. That would be another 1/4 percentage point in the current year. But I think at this point, the level is just about as high as it's going to get, and that a lot of people have started to focus on the timing for potential rate cuts in 2024. And while I certainly foresee that this is a possibility, I would also point out that Chair Powell has raised the possibility that the Fed is not going to stop shrinking its balance sheet, rolling off its Treasury securities, even if it begins to reduce the Fed funds rate in 2024. Has anything like this ever been tried at home? No, it hasn't. But that does not mean that there's not a body of literature floating around inside the Federal Reserve supporting that kind of a balanced or hybrid monetary policy approach once the Fed funds rate does start to come down. Again, what's important here is the persistence of higher levels of interest than what preceded the pandemic and how long they stay. If the Fed brings, let's say we get up to 5.5%. Before 2023 is over, if the Fed takes that down to 4.5%, hypothetically by the end of 2024, that's not going to make a lick of difference for a company that needs for that 4.5% to be zero. And I think that that's what the focus should be. If Chair Powell is simply effective in continuing to run the balance sheet down and maintain relatively high levels of borrowing costs vis-a-vis pre-pandemic levels, then he will have achieved his higher for longer mission.
Well said. So I think even maintaining these levels or lowering it, like you said, is still a form of restrictive policy compared to what we had before. Now, I want to go into this concept of they continue their QT, reducing their balance sheet, letting these treasuries roll off while being able to lower or maintain these rates. What are the effects for people? It's obviously going to be liquidity issues, but what do you foresee? This is uncharted territory for all.
So if you continue to roll off the Fed's balance sheet, then in theory, the credit crunch continues. And even though borrowing costs decrease, and let's just say that mortgage rates maybe follow, not certainly to the same extent. It's just the same way that if you see West Texas intermediate prices for crude oil are coming down, you're not going to wake up the next morning and see the same percentage decline at your local Exxon or Chevron station. Doesn't work that way. But let's just say the Fed starts to reduce interest rates and mortgage rates maybe start to come down a little bit. That could be helpful for certain high credit, pristine credit borrowers. But that certainly won't be helpful if the Fed continues to roll off its balance sheet, depleting liquidity from the system, which is going to shut out your high-risk borrowers. And that, I think, applies to both households and to corporations, and at the same time continues to make life very uncomfortable for those inside the Beltway who have a lot less optionality than they had before because the cost to carry the nation's debt is that much higher.
Thank you for that. Now, there's some economists that say that the Fed is making decisions based on lagging data, and they've already over-tightened, and they've done too much, and that they're leading us into a baked-in recession. Do you agree with that thinking?
I don't really think that there was a choice on the part of the Fed because of how the great financial crisis was addressed, because of the reaction function back then. Let's treat a situation in which there's an over-indebtedness, intractable obstacle by adding debt to that over-indebtedness. So once you lay the groundwork for that, then when the time comes, as Powell said back in June of 2012, when he was a rookie on the Federal Open Market Committee, if you continue to just blow up the size of the debt, and that's how you resolve issues then when the time comes for the Fed to extricate its policy, you'll end up with having bad choices. But I don't think that there was a choice. There was never going to be a simple glide path to normalizing interest rates and paying long-suffering savers decent amounts risk-free so that they could be actual retirees as opposed to grandma in Vegas buying high-yield bonds. There was never going to be an easy way to pay grandma 5% for a CD, but at the same time, not have harm to the real economy that has become overly dependent on zero interest rate policy and hypercharged leverage at all times. There was always going to have to be a compromise, and that compromise happens to have the name of recession. Has fiscal spending gone wild worked as a huge offset, including the employee retention credit? Of course it has. That's why we haven't seen a nastier recession than what we have. But the private sector is not fooled. And people in your world, in the cyclical world, are not making huge investments, making huge bets based on some massive recovery in 2024, based on Uncle Sam spending a lot of money. It just doesn't work that way in the real world.
Exactly. Well said. I mean, there's a lot of uncertainty and there's a lot of fear going forward. So people aren't reinvesting those dollars into their business, anticipating huge growth going forward. Plus, margins are compressed. There's less liquidity going around. So they don't have that money to invest. Demand is starting to come down. So we had margins compressed, lower earnings. Now you have the top number starting to come down. You know, inflation works both ways. Like you said, it held that top number up higher because of higher prices. Now the demand's starting to come down. So you're getting squeezed even more. So my opinion, you know, I was in the same business I had a few businesses, but through 2007, 8, and 9. And, you know, we saw a lot of consolidation going on, and you either get acquired or you fold. And it's unfortunate, but it's like a tightening of the belt going on. And we just don't know how far it will go. It will take time. It's definitely a slow process. So talking about this recession, now, what is your best case to worst case scenario, the scale you see going into next year and further regarding a recession? Do you think a severe recession could occur?
I think that the bigger risk right now is that there's going to be a shock to the unemployment rate, and that we're more so going to have a long, drawn-out recession, not something that begins and ends very quickly. Because once you start to take out one cohort at a time that is living based on the strategy of hope that the Fed's going to bring zero interest rate policy back, once you have one contingency after another be forced to face the reality that that's not what Powell is going to be delivering anytime soon, then you're going to have this slow bleed working its way through the economy. Worst case scenario, since you asked the question, is that there's some kind of a contagion that breaks out in the credit markets, and that you end up having one company that is going out of business feeding off of the other. You have some kind of a wholesale exit of a major market that causes disruption in the financial system. And that would potentially catalyze Jay Powell to push forward with the pivot that people seem to really want. But boy, that's for the wrong reason.
Exactly.
And you don't want to have an Armageddon moment force Jay Powell to pivot and pivot hard, because that means that whatever the global recession is that we're experiencing today has turned into something that's that much worse.
Well said. Thank you so much for your valuable input. I want to end on this last question. It's regarding one of your tweets, and I love your tweets. I tell everyone to please follow you on Twitter. Really just brilliant insights. So you had this tweet that said, "Are we in a secular cycle that began in June 2009? I love that tweet because I think about that myself. Please tell us what precipitated that thinking.
So the shortest recession in US history prior to the pandemic was 6 months long, and that was in between the double dip recessions of the early 1980s, 1980 into 1981. Very unusual to see a quote unquote business cycle play out in the space of 2 months. So I look at what occurred, the heart attack that the US economy had in March and April of 2020, which is as long as the National Bureau of Economic Research dated that one recession. I look at that not as being a recession, but as a shock to the US economy that was more than offset by the fiscal response that was fully monetized by monetary policy, the Federal Reserve gone wild. So if you really want to look at this long economic cycle, and you could apply the same exact logic to what's going on in China, what we're seeing now, I think, is something that began in June of 2009. I think we're 170 months in to the longest economic cycle in US history that has been prolonged by fiscal and monetary policy just completely running off the rails so that they can try and forestall an inevitable where in the end, we know that business cycles are healthy. They're good for the US economy. It's good for the US economy to go in and out of recessions, and for recessions to not be long and drawn out to where companies are paralyzed and don't want to make investments, and or worse, can't make investments in the country's long-term prosperity. So that is where I posit we are right now, 170 months into the longest US expansion in US history.
Wow. You are a wealth of information. Thank you so much, Danielle. You're amazing. So grateful to have had you on the show again. And I look forward to meeting with you again. Please tell our listeners how they can read your QI research.
So please come over to DiMartinoBooth.substack.com. And I'd love for you to become a member of the QI Research reading family. I really do on a daily basis put all of my energies into making sure that what you see is unique, entertaining, and edifying. So I don't want you to just read something that is dry and boring, but actually something that interests you and you walk away and say, I've learned something. And because I've learned something, I now have a better background for when I see this again in my future. So I'd love to for you to come over to my Substack platform. And again, thank you for following me on Twitter. If you already do, at DiMartino Booth. If you don't, I welcome you.
I love it. And you're so creative. I have to say, leave the guns, take the butter. I love that. You're very creative, a lot of historical references in there, very lively reading. I assure everyone it's not dry in any way. So very creative. Thank you so much, Danielle. And thank you to all the listeners.
Thank you.